Hello, I'm Kwesi, and here are three things that happened this week. The Bank of England Monetary Policy Committee decided to keep interest rates at 0.1%. Wow. If you buy cryptos like Bitcoin, Dogecoin, Ethereum, is that really just gambling? And there's an old adage in financial services, sell in May and go away. And investors still listen to this, but is it true? Firstly, the Bank of England's economic update, which was published just last week, their MPC decided to keep interest rates at 0.1%, which wasn't a major surprise to anyone in all honesty. The good news for borrowers is also bad news for savers, and the bank said that they expect the UK economy to recover to pre-COVID levels before the end of this year, which is awesome. The bank also released the money and credit statistics. I personally find this much more informative than the general interest rate because it talks a lot about things like the velocity of money, the availability of credit, and these are key metrics for the economy, even more so now that we head into this post-pandemic phase of our recovery. The velocity of money is about the number of times that a single pound moves from customer to business to its employees and staff to other businesses and to the government in tax revenue that they collect along that process. Whereas credit is the availability and the amount of borrowing, the interest rate that is charged on this borrowing, as well as the deposits that households and businesses put in the bank and that this borrowing is secured against. So the figures from the Bank of England show that households saved 16.2 billion in their bank accounts, and that's just in March. They did this really as the average savings rate dropped to 0.1%. Woohoo! The low interest rate on savings, though, means that more people are paying back debt, and the net debt repayment was 0.5 billion that was paid back in March by borrowers. The effective rate on new loans is dropped to 5.03% compared to 7.02% that it was in January 2020. In the mortgage market, the net borrowing was about 11.8 billion in March, which is lower than the peak it was in November 2020, but still higher than the pre-credit crisis peak of 10.4 billion, and that was in October 2006. The effective rate on new loans drawn down for mortgages is 1.95%, which is up from 1.85% that it was, and in the previous month, and in August it was 1.75%. The effective rate is what people pay as opposed to what's advertised. And there's no doubt that some of this new borrowing was really driven by the stamp duty end that was expected at the end of May, but never happened, as we all know. The enthusiasm from buyers wasn't necessarily matched by the same level of enthusiasm from sellers. This meant that there was an over demand compared to the amount of supply in the market. The excess of buyers versus sellers is really at an all-time high, the highest seen in the past 10 years, in fact. And the number of buyers inquiring about each property on Rightmove is up 34%. Wow. The average stock per agent on Rightmove has fallen to the lowest level it was since July last year, which was really when we were coming out of the recession and the first lockdown, if you remember. The question everyone's really asking is, does this undersupply and overdemand really point to another housing bubble? Watch this space and time will tell. The other thing I wanted to talk about was investing in crypto and whether or not that's really just tantamount to gambling. So if you buy Bitcoin, Dogecoin, Ethereum, or any other digital currency, are you just a gambler really? The recent volatility in the crypto space means that Bitcoin last week was up almost 100%, Ethereum was up over 300%, and Dogecoin, the favorite of Elon Musk, was up more than 12,000%. And that's the one coin that nobody was supposed to take seriously, apparently. But according to Andrew Bailey, governor of the Bank of England, if you invest in crypto, that's really just gambling and you should be prepared to lose all your money. Mainly because crypto obviously isn't backed by any government or central bank at all. which isn't a surprise to anyone who's investing in crypto these days. But a lot of people think that investing in crypto is a good thing because the government don't back it and because they don't interfere with it at all. According to Bailey, though, Bitcoin is volatile and is in fact a commodity and not a currency. We know relatively little about what informs the price movement, and it's an odd commodity because it has a fixed supply. The governor went on to say that financial regulators do not regulate commodities in general, and in the immediate pressing future, they don't see this changing. Indeed, currencies, cryptos, do not have any intrinsic value, and for a lot of people, this is what they tend to become kind of focused on. But in finance, there is such a thing as value beyond the intrinsic value, and that does not mean that they don't have any value at all. So there's something called the extrinsic value. Extrinsic value is defined as the price minus the intrinsic value. Now let's assume that cryptos are currencies. In the general sense, currencies have 6 key attributes that they must meet: scarcity, divisibility, utility, transportability, durability, and counterfeitability, or the ability to avoid being counterfeited. A couple of ways that cryptos have value really is that, for example, they're able to store their value. We've seen that they're highly volatile, but what we've also seen is that very few have dropped in value from where they were when they were issued. The other thing is around their ability to act as a medium of exchange. Bitcoin in particular holds up well against the others when it comes to this measure, and that's the one thing that some people thought that it wouldn't necessarily be good at. Yet last week, it was announced in the UK that taxis will start to accept crypto from November 2021. That's not that far away, and this planned rollout of new technology will mean that consumers get protection similar to what traditional card payments offer. The new technology will be built on the Ethereum blockchain. And actually, in a similar vein, not too long ago, SpaceX announced that they will be accepting Dogecoin as payment to launch a space mission next year. Now, I wonder where that space mission is going to go to. To the moon! Literally, it's a lunar space mission. So back to the Bank of England, and despite the doubts of the governor over crypto, as far back as March last year, the Bank of England said that it was looking into the design of a central bank digital currency, effectively a virtual version of sterling. And just last month, the bank announced that it would be joining forces with the UK Treasury in its effort to create its own sterling digital. Now, despite all of this, it's clear that central bank digital currencies are going to have a role to play in the future going forward. So watch this space. And the last thing that I wanted to talk to you about is, should you sell in May and go away? There's an old adage in financial services which goes, sell in May and go away. And many investors still listen to this advice religiously. But is it true? Are there benefits being missed by investors when they choose one alternative over another? Is it better to invest in the winter, or is it better to invest in the summer? As with all things, it's always best to start with the data. And the simplest way to test this is to look at monthly returns across different markets, across different periods of time. So let's say May to October being the summer period. This can then be compared with likewise returns during the winter period, let's say November to April. And plenty of data exists since 1970 onwards really for this period, and we could probably exclude 2020 for obvious reasons with the pandemic. And so based on this data, a few things stand out to me. Monthly returns on average are 1.5% higher in the winter than the summer. This indicates that investors have earned on average 6 to 12% more through the whole winter period than they do during the summer. And while summer returns tend to be lower than other periods, they're still positive. When winter returns are negative, summer returns are lower, if that's interesting. Lower summer returns have been associated with a major downturn in the economic winter. So should we follow this advice and sell in May and go away? Well, no, because the markets do not go down over the summer months, they just go up by less. That means that the returns still tend to be positive, just lower compared to the winter. and it means you risk losing out if you come out of the market altogether. It's about time in the market, not time in the market. And to be distracted by short-term performance in this way is always a mistake, in my view. That was 3 things that happened this week. Hope you enjoyed it. I've been Kwesi, and we'll see you next time.